Hey, what's going on YouTube? We are going to go through Enphase, ticker symbol ENPH. Also, in this video, we're going to compare Enphase to Canadian Solar, First Solar, and Solar Edge as well. Some of you have asked about seeing a comparison, or not even just a comparison, but a breakdown on Solar Edge and Canadian Solar. But it'll give you a good idea where the financials kind of sit in comparison to Enphase. And then also we'll look at the technical chart pattern as well. So year to date, Enphase is down about 18%. Over the course of 1 year is down about 37%. And Enphase recently reported their Q1 earnings missed on EPS and also missed on revenue. And we can look over here with there being 28 total revisions on EPS in the last 90 days. 25 of those revisions have been made lower. So expectations are getting pushed a bit lower yet on Enphase, even still after all this time. So in their Enphase's Q2 outlook, revenue was to be within the range of 290 million to 330 million. And we can see that is slightly above where they were just this most recent quarter. So we also know that they say Q1 is a bit of a seasonal quarter, a slow season. To be expected to see revenues increase, hopefully for the next quarter or two. We'd like to see them increase a lot more than that, but we also know that this company is very cyclical and is also a high level of a commodity-based business. So also another thing they mentioned was that the US revenues dropped 34%, but the Europe revenues increased 70% on a sequential basis. So they're seeing significant increase in demand in Europe. And obviously, US still not seeing significant demand at the current time. Obviously, demand is very shallow in the US market because interest rates for solar is sitting around 9% when it used to be about 4%. Obviously, not that long ago when interest rates were at about zero. The Fed rate was at around zero. So that's obviously a huge reason why Enphase is not doing very well in the current time. But we're going to jump over into the financial spreadsheet, and we're going to take a look at how Enphase has performed historically and to honestly get a pretty good idea of how it can perform in the future as well, as long as this business can hold in there and hang in there and be around for the future. So we can see here on revenue, gross profit, and net income, all three charts, up to 2022, fantastic growth. Things were looking really good. 2023, even still looking pretty decent. And we know in the trailing 12 months, things are getting pretty ugly in the solar industry currently. And net income, we can see net income was doing just fine, doing great. We got gross margins in upper 40%. Even last quarter wasn't that bad. It's within range of where it's been historically. So they're hanging into their margins, at least on the gross side of things. So that's pretty good. Net margins, though, obviously last quarter down 6%. Trailing 12 months, though, still hanging in there at about 15%. We can see, when this company can actually perform, like it can perform really well. So margins are very good, very strong in this business. Return on invested capital sitting at about 9.6%. PE ratio currently sitting at about 56. We got down here cash to short-term debt. We will also break down the cash to debt position a little bit more once we get over the 10Q, but we can see cash to short-term debt. They got plenty of cash to cover their total short-term debts right now, which is awesome. Cash to debt, almost a similar story. Not quite enough cash to cover its total debt, but pretty close. And the other thing too about this is obviously we know this business is going through quite a cycle, a slow cycle, and they're still hanging in there financially, which is a pretty good sign of a strong business in a slow growth cycle for them. Price to sales sitting at about an 8, and historically it is the cheapest price to sales ratio it is seen. We come over here to free cash flow, still producing free cash flow. Gonna probably see this continue to decrease. Capital expenditures, hopefully we start to see these shrink a little bit more yet. Obviously, since they aren't producing as much product right now, probably see capital expenditures shrink a little bit. Share count dilution, company does have a share buyback program right now. They are still currently buying back shares, which we'll see once we get to the 10Q, but not at a crazy amount, which I find that to be, a bit of a good and a bad thing as well. Over to their 10Q, we are going to go through, we're going to start their balance sheet here. And we come over here to cash and cash equivalents on the top line and marketable securities. In total, we can see we got $253 million in cash with about 1.4, almost $1.4 billion in marketable securities. So they're putting their cash to work. So their cash is then generating interest income, which is going to help them out on their overall net incomes. And we can see $1.6 billion in total cash position, slightly down quarter over quarter, but nothing significant. Nothing to be concerned about there at all. And we come down here to current liabilities. We get to strip out deferred revenues in short term and long term. That helps us see our overall debt to cash position actually be a lot stronger than it even showed to be on our financial spreadsheet that we were looking at. So we got $1.6 billion in cash, and then we subtract off our deferred revs from our $554 million in total current liabilities. Leaves us with about $434 million in short-term debt. So that's roughly going to take it down to about $1.2 billion in a strong cash position. So in total, they are sitting on about $1.85 billion in total debt after you strip out your deferred revs on your short-term and long-term. And then you got your total liabilities from here, $2.3 billion, you get $1.85 billion. It's almost enough cash to cover their total debts, so that is still a very strong balance sheet, even in tough times for this company. Then we come down here to their income statement, and we can see year over year, this time last year they did $750,000 in revenues. They just did just above $250,000 in revenues. So obviously the slowdown is real with Enphase right now. That gives them a gross profit then, still positive gross profit of $115 million. And then we come down here to operating expenses. We can see, we compare these operating expenses year over year, and they're not shrinking their OpEx. They're maintaining it, which I find to be, I definitely question that, whether that's either poor management or they're potentially seeing a future turnaround in the near term. And maybe they're just hanging in there until things, maybe they're just hanging in there for just a little bit longer. But if they, I think it's a tough one because obviously we're not there. We're not the ones that are running the business. We don't see these things day to day. We just see the numbers, right? And these numbers to me definitely throw some questions in, like why are we still doing research and development at such a high rate? Same thing with sales and marketing. Why are we doing sales and marketing when we know that right now is not the best time for solar? And nobody's really spending money on that. And then same thing with G&A. Why do you still have people working when there's, I mean, your revenues are cut down by 60%? Like it definitely throws some questions, right? So it's either going to be a good thing, it's either giving us signs that maybe there's hope soon, or they're just not managing their expenses like they should be. So definitely a little bit of a question mark there. But overall, then we got other things. We got interest income, which is nice to see. That definitely helps out a little bit from all that cash they've got invested. And then they got a little bit of interest expense, but that then gives them negative net income loss of about $16 million this quarter. And we come down here a little further, we can see shares went from 146 million outstanding to about 136 million. So bought back about 10 million in shares in the last year. Then we come down to our cash flows. We're going to get right down to, we got stock-based compensation. We can see still sitting at about $60 million of stock-based comp get paid out to the employees and executives. And then we come down here to total cash provided by operating activities. This is all the cash that flowed in and out of the business. They're then left with $49 million. So you could say that the reason why they're even positive cash from operations is because of their stock-based compensation. If it wasn't for that, they would be negative right now by about 20 or about $10 million. But they're still paying out stock-based compensation. Gives them positive cash from operations of about $49 million. We got capital expenditures here about $7 million. We can definitely see capital expenditures are shrinking significantly. Obviously, you would expect that. So that leaves them with about $42 million free cash flow this quarter. Then we come down here to repurchase of common stock. We can see they are buying back stock. They bought back about $42 million worth of shares last quarter. And you could think and say that that's a good thing that they're buying back stock at such a cheap price, or you could say that's a negative thing because they can't afford it, right? I mean, they do have the cash available to do it, but now is also not the greatest of time to be buying back shares, especially when you don't maybe they do know, but it's tough to say when they're going to get out of this deep dark hole that they're currently in within the economy. We don't exactly know when interest rates are going to start falling. We don't exactly know when people are going to say, okay, now we have enough money to start buying solar for our house or for a business or whatever the case may be. So definitely a little bit of another question as to why they're still spending money on this when they maybe should be saving that or investing it into interest income instead. You know, definitely could argue that both ways, I believe. But overall, we can see their net decrease in cash and cash equivalents was about $35 million. So nothing too significant with how much cash they do have overall. And you can say, again, argue that the reason why they saw a net decrease in cash is maybe from stock-based compensation, or sorry, from repurchase of common stock. So over to the comps. Again, we're comparing Canadian Solar, First Solar, and Solar Edge. And Solar Edge is a direct competitor to Enphase. Canadian Solar and First Solar are not direct competitors to Enphase, but we wanted to include them into this video a little bit to see how margins are and how they are financially sitting currently. So in terms of a market cap, Canadian Solar has a significantly larger market cap than the other three businesses. We come down here, we can see revenue, gross profit, and net income. First Solar is definitely the best on the board for like how these bars work. You know, it's just like a perfect stare. And we can see Enphase, similar thing, similar little stair step that they got going on here. Canadian Solar, you got lots of revenue, very little gross profit, very little net income. Solar Edge, same thing. You got revenue, very little gross profit, and negative net income. So it kind of gives you an idea that Solar Edge is producing more revenue than Enphase, but as negative net income. So you'd have to argue that Enphase is performing much better in this tough times than what SolarEdge is doing. And in terms of growth, though, we can see for the most part pretty significant growth forecasted in the next 5 years on all four of these companies. So hopefully things do turn around for them and they can start producing and making money again. Margins over here, we got 46% margin on Enphase, best margin on the board. Operating margin 13%, but First Solar then takes the lead at 31%. Profit margin 28 and a half or 28.75% on First Solar, 15% on Enphase. So again, Enphase, First Solar, two, in my opinion, are the two solar choices. For what I've seen, First Solar has very good financials, and also the stock chart of First Solar, a little overbought, but well, not a little bit. It's definitely overbought, but definitely performing very well I think it's the only best performer in the solar industry right now. And then we got Enphase just hanging in there, just waiting for interest rates to get cut, and then they can maybe start doing something again, which would be fantastic. We got free cash flows though. The only positive free cash flow company on the board is Enphase. That kind of tells you another thing about how Enphase is how the margins and everything are, and how the finances are ran in Enphase very well. They do a very good job. Return on invested capital 9% there for solar, 13%. And then PE ratio 57. Obviously, PE ratios here are a little bit all over because earnings just are thrown everywhere on these companies currently. And that is it for comparisons. You can see, I mean, a little biased, honestly. I am a little biased. I do like Enphase. I also do really like First Solar. I tried to buy that one a long time ago and I missed out, and still have not yet been able to get into First Solar yet. But I do currently hold some Enphase shares. So over here to our valuation spreadsheet, we want to figure out what Enphase is potentially worth today. And not a little bit of some bad news. It's not going to be very good because growth is not yet forecasted at all. And I pulled Solar Edge off of the chart here because Solar Edge is currently negative on earnings. So this gives us a negative price here. And if we eliminate that, then we get a price in comparison for multiple comparison. So over here, P&L valuation gives them $79.32 per share. Multiples comparison, looking at about $31.44. Come over here to price to book at a 5-year average is 36, currently sitting at about a 16 for price to book. PEG ratio, very, very richly valued based on a PEG, but obviously the growth rate on Enphase right now is just not there. Grams valuation sitting at about $113.32 per share. Then to our discounted cash flow valuation, analysts have like basically zero growth rate on free cash flow. I'm going to plug in 4%. Just 4% is just so doable if things can start to turn around for Enphase. So even if that is the case, at just 4% growth rate on free cash flow, and again, the free cash flow is $404 million right now. I think it's possible. If they can, we're looking at about $122 per share. And again, in the future, if free cash flow decides to like really start growing, if the company can start producing revenues again, free cash flow is going to grow rapidly. So right now it's just not great time to value these companies because they're just so beaten down. Then we come to our Rule 72. We're looking at about a future EPS of 8, which gives them roughly a fair value today of $89.05 per share. Then our overall summary. So currently analysts have a price target of $135.66 per share. And today we're looking at about $87 for fair market value. And a 30% margin of safety puts us all the way down to $61 per share. But what we're going to do though is we're going to plug in forward-looking numbers just because obviously right now is like probably the very bottom, hopefully the very bottom of where the solar industry is going to end up. And maybe it'll start to turn things around here in the next coming quarters. Once we start to see interest rates potentially get pulled back, which is forecasted at least a cut or two, which might spark a little enthusiasm into the overall solar industry. So we plug in our forward-looking EPS and our forward-looking PE ratio. P/E fair value then becomes $119. Our comparison, $47.24. Come over here to our grams valuation, $170 per share. Discounted cash flow won't change. I'll leave it where it is. Obviously, if we do start to see growth, this will likely increase the free cash flow growth rate. Then we come down here to fair value. We will see this pop up a little bit, maybe out to about a 12. That gives us a fair value of $133.58. So then our fair market value becomes roughly $118.45. Then the 30% margin safety sitting at about $83 per share. Now we'll hop over to the stock chart and kind of see how this is hanging in there technically. So we've got this orange line in here, which is about a support line where it used to be. Now it's just kind of sitting, bobbing, in between that orange line. It's just above it, below it, above it, below it. We also got this yellow line here, which you can see kind of connects a few dots. It seems to be resistance, as we can see here. The last few times it's hit that yellow line, it's fallen off. It's been rejected, and recently also got rejected again. And then we zoom in here. We got this green line, which kind of ties in a couple lows. We got this low, we pulled back, didn't quite reach that green line. Hit that yellow line, pulled back, hit that yellow line, pulled back. Currently sitting with a big red bar on this green line. The likelihood of getting broken through this or breaking through this green line on this big red bar like that, I think is kind of high. Yeah, I feel like this is more than likely going to come back down, maybe get down to 94-ish dollars per share again, which would be my assumption. It could hold and bounce back up and kind of stay within this little wedge here. But I would definitely assume this to come back down to 100, maybe even down to $93, $94 per share, roughly. That's kind of what I'm forecasting. Obviously, there is no enthusiasm in solar industry right now, unless you're First Solar, which we can look at that stock chart real quick too. First Solar just took off and this is the only solar stock that's just basically doubled, damn near doubled in this year actually. So First Solar is doing really well. Then we can look at Canadian Solar and see Canadian Solar not doing very good either. It's kind of actually it is sitting on a support range down in here. We're sitting around $14, $15 per share. Then you got Solar Edge, which is just continuing to bleed out, and obviously their financials just are not hanging in there whatsoever. If there was one of the four that I would expect to go bankrupt, would be Solar Edge, based on how their financials are hanging in there in comparison to what Enphase is doing anyway. But that is it for Enphase in this video. If you found value in this video, drop a like, subscribe, and comment down below. And we will be back with another stock analysis video.